Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
All right, so much for an expected confirmation of easing inflationary pressures in the U.S. As we've been reporting, going in the other way. U.S. consumer prices jumped at the start of the year. You know that, you've been listening. Stalling recent disinflation progress, Tim, and likely delaying any Fed interest rate cuts. Again, another rethink, if you will, in terms of the trade today.
Yeah, the question is the trend still going in the right direction? With what put upward pressure on U.S. inflation last month, with us is Bloomberg News economics editor Molly Smith. She's here in the studio with us right now. So Molly, today's inflation print, dig a little deeper, peel back the layers. Where is the pressure coming from?
Yeah, I mean, it's unfortunately still coming from a lot of these services categories that the Fed has been so worried about, and rightfully so. Shelter was over 2/3 of the increase, so much for seeing housing costs abating anytime soon. We also saw a big pickup in car insurance and health insurance, and these are things that people pay for every day. So this is like a real hit to consumers out there. And where we did see the easing is, the categories that have been easing all along. So it kind of speaks to that Fed concern that some officials have been raising lately, that the disinflation progress is just too concentrated. It's not broad enough beyond energy and goods prices.
What's problematic when you talk about shelter, when you talk about insurance costs, I don't know about you, but I get my new policy at the end of the year, and that's the rate for the year.
That's it. You're stuck. Exactly. As someone who's signing a homeowner's insurance policy, I just saw that one is going to be also, those premiums are coming up. And of course, if you live in an area affected by climate change, even more so. So yeah, these are things that people are contending with every day.
Tim, home insurance is inexpensive. Tim has had his own
Just
story.
don't even, I kind of put that behind me, Carol.
Tim has a good deal over here?
It was an issue.
It
was an issue.
It's going up. Everything's going up so much. I mean, even if you don't live in a place that's affected by climate change, you're paying for the climate change disasters that are happening, everywhere in the country, because all this stuff is pooled together. Okay, Molly, was there good news in the print? Is there anywhere where we see progress on inflation?
Well, I think it's good news in the sense that, yes, prices of used cars coming down, but there was a little bit of a quirk there that there's a new way that the methodology was updated. So we'll have to see if that's going to be, as much of a drag on future inflation prints, as well as broader goods prices. Those are still coming down, energy as well. But that's just the thing. Like, that's really about it. It's not a broader disinflation trend that the Fed officials want to see.
Well, speaking of Fed officials, right, they have access to multiple inflation reports, including one more CPI print before the next policy meeting come March. Walk us through them, because we always talk about the preferred Fed gauge, whether, PCE, core PCE, super core PCE. Help me out in terms of what we really need to focus on in terms of what the Fed focuses on.
So that's been really the read through today, if we are looking for good news, is that the categories that saw a lot of strength in the CPI report don't have as much of a read through to the PCE. Either the weighting is a lot smaller, or those categories are calculated entirely differently, and it really just wouldn't show up in the same way. So PCE is still seen trending a lot closer to the Fed's 2% goal. Either way, I think this day really nailed the coffin on there's not going to be a rate cut in March, as Fed officials have been saying all along. So I think the market is really so much more on board with that now. And of course, even more time between May, June, July, and whatever those meetings may bring.
Well, I mean, I heard folks on surveillance earlier today saying that it kind of puts May out the window too. And there are questions about, okay, whether or not a cut is going to happen in June. What are your sources telling you? What are they thinking?
I mean, I think it's tough to make a judgment call about May right now when it's February 13th and there's snow on the ground in New York City, and we're talking
nice
about
job, Groundhog.
May. It's tough. But yeah, how can we say that with all the data prints that we're going to get between now and then?
Inflation print, okay, so a little bit hotter than expected against the backdrop of an economy, as Jay Powell reminded us, hey folks, it's not too bad. In fact, it's good.
It is good. Yeah.
But to that point, Carol, I'm wondering how this sort of feeds into the latest jobs report that we got as well, which showed an economy that's adding more jobs than even analysts at the top end thought. And if that is stoking concerns more about inflation being more persistent than people thought.
I think this was also kind of reminiscent of January last year, that all of the data for that month of January 2023 was so strong. And you do get a little bit of a seasonality effect at the start of the year. Granted, a lot of these numbers are seasonally adjusted to try to smooth that out, but it is something that we still see from time to time. So I think some economists have also poured a little cold water on that. And as usual, we're never going to, make a real judgment call based off of 1 month of data, even if it is a collection of data points in 1 month.
I feel like, I don't know how many times we have to hear it either from Jay Powell or Fed officials. Folks, they're data dependent. And so even these daily swings, you got to remember that it's going to ultimately be that class of data or what the data points are come each Fed meeting.
And the revisions potentially.
Really good
exactly.
point. All right, Molly Smith, thank you so much. Economics editor here at Bloomberg News, joining us here in studio.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We're going to shift gears a little bit, talk about the real estate market, in particular here in New York. The vacancy rate for New York City's most expensive rentals plunging to 3.4% last year. Tim, that's the lowest in almost 3 decades.
All right, here's some more numbers for you. So we're talking about rental units costing more than $2,400 a month. Availability fell from about 13% back in 2021. That's according to the latest New York City Housing and Vacancy Survey. It reflects, Carol, a broader housing shortage in the Big Apple not seen going all the way back to the 1960s.
Yeah, so let's get to it. Let's get to the interview at this hour on the New York City real estate market, and an important one and a closely watched one. With us is Lisa Lippman, licensed associate real estate broker at Brown Harris Stevens, joining us on Zoom in New York City. Lisa, good to have you here with Tim and me. What are you seeing in terms of availability when it comes to the housing supply here in New York City? What are you seeing in terms of demand for buyers who are looking for properties?
So we're seeing increased demand. Since about mid-December, I'm seeing a lot more people coming back to the market to purchase. We definitely had a lull from last spring, summer through the fall. It was quiet. And in the middle of December, sort of out of the blue, things started picking up. Hard to know exactly why. Often after a period of lull, we get busy again for obvious reasons. People need to move. People die, they get married. They have children, they get divorced. So things started picking up in mid-December. And I feel like this January and early February have been busier than the average early year. Usually our spring market starts more in March or April, but it started earlier this year.
Lisa, how closely is your business tied to the equity market and what we see in the bond market when it comes to rates in the 10-year and mortgage rates? That is, if we started to see markets move higher in November and December, is it fair to say that people would come off the sidelines and say, okay, wait a second, I feel wealthier now. I'm ready to make a big purchase. And at the same time, I'm also seeing mortgage rates come down slightly from what we saw over the past few months.
Absolutely. My market is definitely tied to those factors. Having said that, we have a lot of wealthy cash buyers in New York, which has continued to fuel our market. And the buyers that purchased in the fall were by and large cash buyers at every price point, from 1 million all the way up to 100 million. And even the uptick that started in mid-December that's continuing now, we still have a lot of cash buyers, although I'm starting to see people who will finance creeping back into the market.
Yeah, that's interesting. I guess, when we hear something like this, I'm always curious, Lisa, in terms of perspective. So like what you're seeing today in terms of the real estate cycle, how it compares to probably a lot of cycles you've seen. Is it a typical one, in terms of the amount of people buying by cash? Is it make sense, maybe the amount of people you're seeing, starting to maybe tap into some loans? I mean, give us some perspective, because you've been in the industry for a while, so you've seen a lot.
Yes. I've been in the industry for 25 years, and I worked through 9/11 and post 9/11 and the financial crisis, and then obviously, the latest big depression, recession. The difference now is that there are a lot more cash buyers than I've seen in the past. And, since I've started doing this, interest rates have come up and gone down. But this most recent rise in interest rate was the largest percentage rise. And that really pulled a lot of people back, freaked a lot of people out. I've been doing this long enough to know that, even now the interest rates aren't really historically that high. but in relation to what they had been, it freaked people out. But what we learned about the real estate market now is that there is so much wealth in New York that has been created in the last few years with the stock market that there's a lot of cash buy. There's a lot of cash out there, and there are a lot of cash buyers. Now, the important thing about cash buyers is they don't overpay. They expect to get a good deal because they're paying cash.
Okay, so if somebody's a seller out there and they get an all-cash offer that's not at their price point, what's the next step here in terms of countering in a realistic way, taking into account that this thing could close quickly and not necessarily be dragged on by the financing process?
Well, I always encourage sellers to look at reasonable offers carefully, and especially cash offers. If something's financing contingent, it's never as interesting. A cash offer is always interesting. And, something that we learned in the last 10 years when the market hasn't been as gangbusters as it might have been at different times. We had this really crazy market in 2005, 2006. We had a mini crazy market from 2014 to 16. But at other times when things weren't like that, any offer you get, especially cash, should be looked at seriously, and you should play ball with that person.
Hey, are all the buyers American?
Most of them are. I'm seeing about 80% domestic buyers, 20% are foreign money, but it's not where it used to come from. We see a lot more South American money. We see some European money. And then we see some money coming from Asia, but places like Singapore, Taiwan, Korea, different than we used to see.
So in other words, not seeing China.
Correct.
What about Russia? Are you seeing Russia?
We see no Russian money. I haven't seen any Russian money in several years.
It's funny, New York City, we always talk about location, right? When you talk about anything in terms of the real estate market, New York City has a lot of different markets in the residential space, uptown, downtown, east, west. So walk us through it. What are the properties that people are most interested in right now, or where in New York City?
All right, well, downtown's always popular. West Village is always popular. Tribeca, especially prime Tribeca, meaning west of Church Street, is always super popular. Soho, very popular. The 57th Street corridor, Midtown, tends to be less popular, except for the period of time where we saw lots of Chinese and Russian buyers buying there. Not to say that people don't buy there, but less popular. And then, of course, we have the Upper East Side and the Upper West Side. On the Park is always the most popular. And then beyond that, what's really been the most popular for several years is anything that's in really beautiful condition, move-in condition. People are very wary of doing renovation. It started before COVID, but certainly during COVID and since COVID, the cost of doing renovations in New York City is very, very high. And to get somebody to buy something that needs a lot of work, you really have to be priced very, very attractively. Otherwise, people just don't buy properties that need work.
What do you have on your radar, just in the last 30 seconds that we have, of perhaps the biggest shift that you can expect in the next few months as we get into that spring real estate season?
I think that it's going to get more competitive for buyers. Buyers have gotten used to, in the last 6 months, being able to sort of drag their feet, making offers, take a long time making a deal, expecting to be the only buyers. I think they will see more competition. So I think that'll be a change. But what I also want to warn sellers is, sellers are always very slow to react to a softening market, and they're often too quick to react to a market that they see as getting better. So what will slow down our market again is if sellers start raising their prices. That there is a danger in that.
All right. Interesting take on that. Hey, Lisa, thank you so much. Lisa Lippman, she is licensed associate real estate broker at Brown Harris Stevens, joining us on Zoom from New York City.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's get to another edition of Bloomberg Plugged In, your weekly look at EVs. And Tim, this week we're focusing on a crucial component of EVs we talk about a lot, and that is the battery.
Yeah, and we also talk a lot about the stuff that goes into lithium-ion batteries that power EVs. Lithium, of course, but also cobalt, nickel, and more. Some of what goes into batteries can be scarce, and then there are the environmental and human rights issues associated with mining some of these elements. Enter Solidion Technology. It's a newly public company that's focused on developing a more sustainable battery. Jaymes Winters is CEO of Solidion Technology. He joins us on Zoom from Dallas, Texas. Jaymes, good to have you with us this afternoon. So let's take a big step back and talk about your business. Have you successfully created a better battery?
Well, first of all, good afternoon, and thanks for the platform. I think where it begins at is what is a battery. First of all, what is a battery supposed to be doing? A battery is supposed to be generating clean energy and displace all of the use of petroleum or hydrocarbons. Right now, a lot of the batteries, the components are actually putting more hydrocarbons to use in terms of mining, extracting, and if you look at the part of the anode, where the anode is right now, a lot of the synthetic is actually made out of petroleum coke. What kind of sense does that make? A petroleum coke, you're making petroleum to make a battery.
Yeah.
So we want to use all natural, to the extent that we can, natural.
But what does natural
components.
mean? What does natural mean? Because organic means something from the government's. I don't know. Natural means nothing. So help me understand what natural means.
Well, for the graphitization part, which would be the negative part of the battery, we want to use biomass, recycled biomass to make the graphite, and that means that this is really all natural. We are consuming a lot of what I would call disposable product in doing so, but we're doing so in a way that's going to benefit the environment. In the totality, it's going to benefit the environment, and it's going to put the battery in a place where it's more carbon neutral than it would be using other types of manufacturing.
Jaymes, I still want to make sure I understand this. We have lithium-ion batteries that use nickel, that use cobalt, that use lithium. Those are in production right now. We have battery suppliers sending batteries to Ford, to Apple, to Tesla, and more. Have you successfully been able to build a battery that will power EVs that uses graphite?
Well, first of all, we don't build the whole battery. We're just materials only.
Has that battery been built?
There are a lot of batteries that use, just about all batteries are using graphite, but none of them are using the synthetic graphite from biochar, which is what we're going to be producing. And no, none of those are in production yet, but that's what we intend to do.
What's the timetable for that, and what's holding it back at this point?
Well, obviously, with this was a SPAC merger. And the SPAC merger is really there to capitalize the target company. And now that the merger has been completed, we will obviously shift gears into capital raising mode. And in the next 12 to 24 months, it doesn't take very long for a graphitization plant, as opposed to a battery cell manufacturing plant, to be put into effect. But we hope in the next 12 to 24 months to start and complete construction of the first natural or synthetic natural graphite plant in the United States.
Wow. Hey, go ahead, Carol.
Well, and I'm curious. All right, so certainly for investors, we're looking at, it's a small cap company, very micro cap, in fact. What customers are lining up, if there are, to work with you specifically? We have a great function on the Bloomberg, the supply chain analysis. Tim knows I'm obsessed with it, but it gives you an idea of, who's buying a company's services, who are their customers as well, or who they are buying from. So we get to see the whole supply chain. Who has signed up to be part of your supply chain?
Well, let me say that we have had a lot of inquiries about the carbon neutral approach of graphitization and the graphite anode. That's probably all I could say at this point. but there have been a lot of inquiries, and it does take a little time to have people actually, line up and start purchasing everything. There's one key driver there. The Inflation Reduction Act is requiring the U.S. to have all its materials from domestic sources by 2030. So I think that until 2030 or leading up to it, you're going to see a gradual phasing in of U.S. manufacturers for this product and a phasing out of sources from China, which is probably 86 to 90% of the market right now.
Hey, Jaymes, before we go, you've only been a public company for a very short time here, but I do have to ask about a day like today where we're seeing the entire market sell off. You're certainly not immune to that. In fact, shares of your company down about 22% as we speak. Big picture, does a day like today make your job that much harder to go out and sell this idea to investors, sell it to customers?
It does provide some challenges. I would say that not just our company, but the entire sector, the EV infrastructure, the sector, the batteries, the cars, there's a real question as to is the adaptation a little bit ahead of its time?
Oh, yeah.
But that would be the bad news. The good news is we're coming in when we feel the adaptation will be spot on, and not the companies that came out earlier. I think that they're going to, they have probably faced some pretty big challenges economically and building these facilities at the height of inflation. I think our facilities will be built at a time in which the inflation is a little bit more under control, and we'll have somewhat of a competitive advantage, but it does present its challenges for investors.
Hey, Jaymes, one last question, 30 seconds. Where are you building those facilities?
I would say that we're looking at a number of different places. It makes sense right now for a lot of companies that are similarly situated to be based in the southeast part of the United States because of the excess utility grid and utility power. So we're looking around there. We should have something out that's more definitive in the near future.
All right, going to leave it there. Hey, Jaymes, thank you so much. Jaymes Winters is Chief Executive Officer of Solidion, joining us, Solidion Technology, that is, joining us on Zoom from Dallas, Texas.
I'm driving in my car, I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just about 17 and a half minutes left in today's trading session. We're just coming off our worst levels of the day when it comes to the equity trade. So we're seeing some buying here in the last 20 minutes or so, but still down across the board. Let's get to it. Our Drive to the Close guest on this Tuesday, Carol Schleif. She's Chief Investment Officer at BMO Family Office, joining us from Minneapolis. Carol, good to have you back here with Tim and myself on Bloomberg Businessweek. How has your day been today?
It's been just fine, actually, and I think it's been interesting to watch. I think people have gotten a little out of hand with fear, if you will, over the CPI report, obviously, especially when you roll back and look to where the futures markets are discounting potentially 3 to 4 rate cuts starting summer, and that's basically what Chairman Powell said back in December. So I think it's quite a bit overdone, but for the most part, people are taking it all in stride.
You think the reaction is overdone?
Yeah, I do. I think a piece of it is the market had counted on multiple cuts starting in the spring and was really keyed in on this March cut. Never really quite understood why, because if you had 6 or 7 cuts this year, that would be indicative of a really ailing economy, as opposed to the Fed's been pretty clear in its messaging, indicating that they're most likely done raising rates. The rate cuts 3 to 4 were in the last set of dot plots, basically, when you were looking at it. And so this market running ahead of things is what we think was a little out of whack, if you will, and just bringing it back in seems pretty normal.
Well, then I think I know the answer to this next question. So if you think that the market was getting ahead of itself, we talk about things like relative strength index, and the market definitely showing it was overbought by a mile. We're now back below that level, so we've seen a little bit of a reprice. This is a good thing in your view in terms of taking out some of the fluff on the equity side of things?
Yeah, I think it's a more normal thing because coming off of the ultra exuberant final couple months of last year and into this year, hitting new highs, it takes some time to back and fill and to absorb those. And actually, if you're a technician and look at the charts are still really constructive in terms of the base that's been built over the last couple of years in the major indexes and the breakout and the bit of a pullback. So yeah, it's pretty normal in here, and the Fed's got us all trained to watch each and every data point. And so if they surprise at all, you're going to see these reactions both to the up and downside. But we still think that underlying trend is gradually upward through the year because the bit hotter CPI and the bit hotter GDP and employment numbers we have are overall indicative of an economy that's functioning pretty well.
So when you think about, we had some fun this week with Wall Street projections on the S&P 500 that when the S&P moved above 5,000, how they'd blown past a lot of street expectations for the end of 2024. Having said that, do you think that this is a market where an S&P is up about 3.6% year to date, that maybe we go back and forth a bit as we figure out Fed policy, Carol, and that maybe ultimately by the end of the year, those projections maybe won't look so silly. It's just going to be maybe a lot of up and down, a lot of volatility in terms of the equity trade.
Yeah, we do think you'll see that volatility. We actually had expected to see more slowing in the economy in the first part of the year and then more of an acceleration in the back half of the year. But yeah, you've got a lot of things that are still lurking in that worry closet. We've got potential government shutdown to get kicked down the road again, theoretically, in another couple weeks. We've got lots of stuff that's out there, and not the least of which is a very big event coming in November. So there's lots of reasons for the markets to remain volatile through the year, but we do think that overarching trend is going to be up. Our expectations starting the year were for a more normalized 8 to 10% kind of market returns off of last year, where we ended last year. And so this volatility is very much in keeping with intermediate and long-term portfolio construction.
Okay, I want to talk a little bit about the bond market here because we're seeing yields up 13 basis points on the 10-year, up 17 basis points almost on the 2-year. Yields up across the curve. Does it change the way you're thinking about the bond market this year? And where are you putting money to work in the bond market?
We're still staying, especially for new cash, we're staying towards the short end. We had finally last October, when the rates were when the rate on the 10-year hit between 4.8 and 5, we had moved out to neutral duration. But the rates coming back up is actually more of a normalizing in the curve. We thought it was pretty unusual to have them go from 5 to below 4, and that was a little overdone. And again, it was tied to that exuberance about how soon and how aggressively the market interpreted the Fed was likely to cut. We expect that interim rate to be something, especially on the 10-year, to settle in over the long haul, more like 4.5%. So it's still, so bonds still have some room to pull back, and that's where, especially for new cash, we'd keep it at the shorter end of the curve, still thinking that you've got some more rate escalation, if you will, in that mid to long range.
Yeah, we were talking earlier with our Michael McKenzie about 4.5 to 5% on that 10-year, according to some sources. Good call on the short end, where you've got a 2-year right now at 4.64. So well done. One thing I wanted to tap into, as we focus so much on the U.S. market, I get it, but we've been talking a lot about the resurgence in Japan specifically, and we know it's been a tortured
30 years
kind of move. A little bit better, more, recently. It's up 13% year to date. If I look at the Nikkei, you have increased exposure to Japanese equities across the market or some specific areas, Carol?
Really across the market. It's tough to find. I mean, we're on the hunt for some high quality active management there because we do think there'll be some opportunities there. But when you look at what's going on in Japan, and I agree, I still remember back when Japan was on the cover of every magazine because they were going to take over the world, and then 30 years of false starts in here. But there's so much going on, especially from a corporate governance standpoint, from an activism standpoint, from trying to move that market and get all of those equities there that are trading below book value up towards book value. So there's a lot of concrete things that are theoretically different this time around, although I shudder to say that phrase because you're never supposed to. But let's hope. But a nice, easy way to start increasing exposure there is through just owning the broad market ETF, because a lot of the globe, especially the developed market funds, are pretty underweight Japan up until the last year or so, because a lot of us have been around to see this game before.
Good point. Carol, thank you so much. Carol Schleif, Chief Investment Officer at BMO Family Office, joining us from Minneapolis.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.